Okay, let's jump right into this explainer and run the $32 billion medtech giant ResMed through our ultimate gauntlet. Now, if you follow the medical device space at all, you already know who they are. But today, we're going to look way past the standard Wall Street narrative and discover together what the numbers are actually trying to tell us.
Right off the bat, there is a massive curiosity gap here. You've got this truly formidable enterprise with a $32.38 billion market cap, yet the stock has plunged 21% from its 52-week high of $293.81 down to roughly $224. And, this dramatic pullback has left investors with a burning question. Is this a rare wide moat value play that you should be grabbing right now? Or is it a classic value trap with fundamental cracks hiding just beneath the surface?
To figure this out, our agenda today is absolutely packed. We're going to start with a quick reality check, run the stock through our valuation gauntlet, uncover some hidden media blackout flags, consult the investing legends, and then finally deliver our wide moat final verdict.
All right, let's get into part one, the valuation model gauntlet.
Now, instead of getting completely bogged down in every single variable here, we can basically chunk this data into 5 distinct groups: the cash flow and discounted cash flow models, which are looking at the actual hard cash the business generates after paying its bills, show a really strong valuation range of $240 to $320 a share. But when we evaluate ResMed strictly on its tangible assets, like the physical stuff it actually owns, we see massive discounts. Dropping as low as $25 in a fire sale liquidation scenario. And that's really because ResMed's true value is locked up in its intangible patents, not just its factories. Finally, factoring in real options, things like the rollout of their AirSense 11 platform and their Oura Ring partnership, adds about $15 to $30 of option value to that base.
So what does this all mean? Well, synthesizing all 21 models yields an average intrinsic value range of $200 to $295 per share. When we look at ResMed's current price of around $224, it sits pretty comfortably within this range, leaning just slightly toward the lower end. This tells us that the stock is currently fairly valued to maybe slightly overvalued, depending heavily on how much weight you give to those physical assets versus their future cash flows.
Moving right along to part 2, the media blackout flags. Okay, let's kick this off with a pretty major red flag. Their free cash flow conversion is definitely weakening. ResMed generated $939 million in cash against a net income of $1.52 billion. That is a pretty weak 62% conversion rate. And while sure, cash flow is still positive, it's a metric we absolutely need to keep an eye on. But wait, ResMed counters this with a massive green flag. They have an absolute fortress of a balance sheet. They're sitting on a net cash position of roughly $644 million. We're talking $1.47 billion in cash against just $826 million in debt, which creates an incredibly low debt-to-equity ratio of just 12.54%. That is rock solid.
But looking a bit closer at the remaining red flags, there is definitely some near-term turbulence that the mainstream media just kind of glosses over. They're facing headwinds from a recent $42 million reserve for an Astral ventilator recall, plus the divestiture of their MatrixCare software business. At the exact same time, their spending on R&D and day-to-day administrative expenses is actually outpacing their moderating revenue growth. And overarching all of this, the existential threat of GLP-1 weight loss drugs. While ResMed claims patients on GLP-1s actually show higher sleep therapy initiation, the long-term impact of these drugs reducing the overall prevalence of sleep apnea remains a massive, massive overhang. But hey, let's flip the script and look at the green flags, because the long-term resilience here is just undeniable. They boast an Altman Z-score of 10.99, which is way above the safe threshold, meaning there's virtually zero bankruptcy risk. They've got a near-perfect Piotrowski F-score of 8 out of 9, signaling exceptional financial strength. Their operating margin sits at a staggering 31%, which is totally top tier in the medtech industry. Plus, their cash flow quality is highly robust, generating $1.25 in operating cash flow for every dollar of reported earnings. Add in a recent 10% dividend hike and confident insider buying in that $180 to $200 range, and you've got a seriously strong foundation.
All right, let's jump into part 3. The legendary investor reality check. First up, we've got the father of value investing himself, Ben Graham. And spoiler alert, Graham would brutally reject ResMed. Based on his strict formula, his valuation comes out to just $102.50 per share, implying the stock is currently overvalued by more than 2 times.
Why? Well, because Graham heavily favored hard, tangible assets. For a strict Graham disciple who basically refuses to buy an asset unless he can literally drop it on his foot, paying $224 for a company with so few physical assets is just an absolute non-starter, no matter how good the underlying business is.
Next up is Peter Lynch, the absolute master of growth at a reasonable price. And honestly, he would probably pass on ResMed too. His framework demands a low PEG ratio, which balances a stock's price against its expected growth. With a ratio of roughly 1.8, it's just too expensive for his taste. The multiple simply doesn't match the growth rate. Warren Buffett, on the other hand, the champion of quality at a fair price, would be highly interested. ResMed passes the Buffett test with flying colors thanks to its pristine net cash balance sheet and an exceptional return on invested capital of nearly 24%. But while Buffett would definitely love the quality, the owner's earnings yield is only about 5.4%, so he might not take a swing at it right this second, likely preferring to wait for a real fat pitch closer to that $180 52-week low.
And that brings us to part 4, our wide moat final verdict. Morningstar gives ResMed a wide economic moat rating, and it's basically driven by this expanding trifecta. About a third of it comes from massive intangible assets. We're talking over 700 patents, rigorous FDA clearances, and 3 decades of building brand trust. Another third comes from high switching costs. Once patients are prescribed specific devices and masks, and healthcare providers get locked into ResMed systems, they very rarely switch. And the final piece? Powerful network effects from their AirView cloud platform. As more patients and providers join that ecosystem, the data just gets richer, and the platform becomes infinitely more valuable.
Ultimately, when we synthesize all of this data, it brings us to a blended intrinsic value midpoint of right around $240 to $250 a share. At its current price, ResMed is a world-class franchise trading at a very slight 5 to 10% discount. So it's not some deep value bargain that's going to make Ben Graham jump for joy, but rather it is a high-quality asset sitting at a fair price. You are essentially paying a premium multiple for exceptional returns on capital, a total fortress of a balance sheet, and a widening competitive moat. So we've laid out the entire gauntlet for you. On one hand, you have this pristine business model and an incredibly sticky ecosystem. But on the other hand, you have decelerating growth, the looming GLP-1 threat, and a valuation that offers a very little margin of safety. So, is this a wide moat that's actually worth paying up for? Or is it a growth trap where you should just sit on your hands and wait for a much better entry point? Which side are you on? And more importantly, what will you find when you dig in and do your own homework? Thanks so much for joining me on this explainer, and I'll catch you in the next one.